Welcome to Iron Financial, the show where we forge stronger portfolios by putting the market's biggest names under some serious stress tests. Today, ASML is on the anvil. Now, look, they just dropped what, by any measure, should have been a grand slam quarter, a home run. But the market took a sledgehammer to the stock, and for us, that is a massive red flag. So our job today is to figure out exactly why. Is this company built on solid bedrock, or did we just hear the first telltale crack in the foundation? Let's get to work.
Okay, hold on. Let's just lay this out. A beat on sales, a beat on profit, and they raised their forecast for the future. You tell me, in what universe does that add up to a sell-off? It just doesn't compute. You have to believe the big money, the hedge funds, the institutional players, the algos, they aren't stupid. They are selling this thing for a very specific reason, and I guarantee you it's not because they suddenly developed an allergy to profits. So the real question isn't what's good in the report. The question is, what are we not seeing? What's buried deep in the footnotes or between the lines? Is this all just some short-term market panic, or did somebody find a genuine structural weakness that the rest of us have missed? That's what I want to get to the bottom of.
And this slide, right here, this lays out the battlefield perfectly. On the left, you've got the facts, the hard data from the earnings report, a completely clean Q1 beat right across the board, and maybe even more important, a huge raise to their full year 2026 guidance. We're talking a target of 36 to 40 billion euros. That's exactly the kind of forward-looking strength that we hunt for. But then you look to the right, and you see the market's absolutely brutal verdict. Shares tumble, and the whole narrative suddenly flips to cautious outlook. One of these sides is telling the real story of where ASML is actually headed. Our job today is to figure out which one it is.
So here's our plan of attack for this explainer. First, we're going to deconstruct the numbers behind this whole earnings paradox. Then, I'm going to build the bull case, what I call the fortress of AI demand. After that, I'm handing the reins over to our skeptic here to take a sledgehammer to my case and find every single crack. From there, we'll map out the geopolitical fault line that's shaking this entire industry. Then we'll look at the company's own blueprint for the rest of the decade. And finally, we'll deliver the iron financial verdict. Is this a dangerous trap, or is this the very opportunity we've been waiting for?
All right, let's do it. Let's get into the guts of this thing. The market is screaming that something is wrong here, that the headline numbers aren't the real story. So let's rip this report apart, piece by piece, and see if the bulls are just caught up in the hype, or if the bears have a legitimate, concrete reason to be selling this thing into the ground. I want to see the raw data. No spin, no fluff. Let's see what's really going on. And right here, this is the bedrock of the bull case. Let's be perfectly clear, this is not a mix report, it's a blowout. Net sales came in at 8.77 billion euros, easily clearing expectations of 8.69 billion. Net profit, an even bigger story, it hit 2.76 billion. That's a decisive 200 million euro beat over the consensus. But the number you really need to look at is that gross margin, 53.0%. That is not just a beat, that is a powerful statement. It tells you this company has almost unbelievable pricing power. This is a fortress. On paper, every single metric that Wall Street cares about came in stronger, better, and bigger than anyone anticipated. This is the data that screams that the company is absolutely rock solid. So let's build on that foundation, because the real bull case for ASML isn't about one good quarter. It's about their unique, unassailable position as the single most critical supplier for the biggest technological revolution since the internet itself, artificial intelligence. We are not talking about a company that is just participating in the trend. We are talking about a company that literally owns the choke point. The entire industry flows through them. So this is about a fortress, built on a foundation of what looks like infinite demand for years, maybe even decades to come.
This number right here, almost 9 billion euros in sales in just 3 months, this is the concrete. This isn't some rosy projection. It's not a hockey stick forecast for 5 years from now. This is cash hitting the books right now, today. It demonstrates the incredible scale of their operations, and it proves that the demand for their machines isn't just theoretical chatter from analysts. No, it's translating into massive, tangible sales in the real world. This is the heavy lifting engine of the entire operation.
And if that revenue is the concrete foundation, this 53% gross margin is the reinforced steel frame holding the whole structure up. You know, a margin this high screams one thing and one thing only: absolute pricing power. It is the definitive mark of a true monopoly. And why? Well, it's because ASML is the only company on Earth that can build these extreme ultraviolet or EUV lithography machines. You can think of them as the most complex, most precise printing presses ever built by humanity, using light to etch circuits onto silicon wafers that are so small they're almost incomprehensible. That exclusivity, that deep, wide technological moat gives them incredible profitability. This margin is the true engine of their financial power.
And hey, you don't have to take my word for it. Just listen to what the CEO, Christophe Fouquet, is telling the market. He says, quote, chip demand is outpacing supply. He's basically telling you they physically cannot build these machines fast enough to meet orders. But even more critically, he says customers are accelerating their capacity expansion plans. What does that mean? It means the big foundries, the chip makers like TSMC and Samsung, are in a flat-out panic to build more factories and buy more of these machines. This isn't a company that's hoping for new orders. This is a company trying to manage an absolute avalanche of demand.
So all of this connects into one massive, self-reinforcing supercycle. It all starts with the tech giants. You know who they are. Microsoft, Amazon, Google. They are pledging to spend literally trillions of dollars on AI infrastructure and data centers over the next few years. Now that money flows directly downstream to the chip foundries, TSMC, Samsung, SK Hynix, and they are scrambling to increase their capital spending to build more capacity to meet that demand. And to equip those new factories, well, there is only one place in the world they can go for the most advanced machines, ASML. Just look at this last point. EUV systems, their most complex and highest margin product, now make up 2/3 of their sales. They are at the absolute choke point of the entire AI supply chain. They aren't just participating in the AI gold rush, they are the sole global manufacturer of the picks and shovels. It's an incredible position to be in.
That's a very nice story. A beautiful, indestructible fortress. But I have seen plenty of indestructible fortresses crumble to dust before. Every single bull case has a weak point, a vulnerability, and my job is to find it. The market isn't run by storytellers. It's run by cold, hard numbers and, frankly, a lot of fear. So let's stop admiring the pretty architecture and start looking for the cracks in the walls. There is a reason this stock sold off, and I promise you, we are about to find it. Time to start tapping on the walls and see what sounds hollow.
And here it is. Crack number one, Q2 guidance. Now, they guided to a midpoint of 8.7 billion euros. And sure, in a vacuum, that is a huge number. But this stock isn't priced for a vacuum, it is priced for absolute flawless perfection. The market was expecting closer to 9.1 billion euros. That's a miss of almost 400 million euros against expectations. Now, in percentage terms, it's not a disaster. But for a company of this stature, trading at this multiple, it's a signal. It plants a seed of doubt. It forces you to ask the question. If demand is so insatiable, then why the cautious guidance for next quarter? It's the first real hint of weakness.
And this brings us to crack number two, margin pressure. You were just bragging about that beautiful 53% margin they just posted. But look at the forecast. For Q2, they're guiding down to a range of 51 to 52%. For the full year, they're guiding flat to slightly down from where they just were. Look, in the world of high-growth tech investing, the trend is everything. And right now, the trend is not your friend here. That explosive margin growth we've seen, it is stalled out. The market sees that, it sees that incredible momentum slowing, and it does not like it one bit.
Okay, and this isn't a crack. This is a sinkhole opening up directly under the foundation. The cash position. Wall Street analysts expected them to be sitting on a war chest of nearly 13 billion euros in cash. The actual number? 8.38 billion. That is a 4.5 billion euro hole. So where did all that money go? This is the number that sent institutional investors running for the exits. Profits are an opinion, cash is a fact. And right now, the facts are that ASML's cash is disappearing at an alarming rate. Was it just aggressive stock buybacks right at the top of the market? Did they overpay for supplies to meet that insatiable demand? Are capital expenditures spiraling out of control? We don't have the full answer, and that uncertainty is absolutely terrifying to investors. This is, without a doubt, the single biggest red flag in the entire report.
Okay, that cash number is a very serious point, and we are going to circle back to it. But first, we absolutely have to address the major external forces at play here. We've inspected the internal pressures, but there is a massive earthquake shaking this entire industry, and ASML is sitting right on top of the fault line. We're talking, of course, about the geopolitical tensions between the West and China. And this is no longer a theoretical risk, it is actively hitting their bottom line.
And if you want to see what that geopolitical risk looks like in real time, just look at this slide. It's staggering. On the left, that was Q4 of last year. China made up 36% of their system sales. It was their single biggest market by a country mile. Now look to the right. 1 quarter later, Q1 of this year. China is down to just 19%. Their sales to what was their number one customer were cut almost in half. Slashed. In just 90 days. That is the real-world, brutal impact of US and European export controls. A massive growth engine for this company has just been shut down.
and there is absolutely no guarantee it is ever coming back.
It's a massive hit. There's no question about it. But to ASML's credit, they are not hiding from this. They state it right here in their report. The uncertainty from these export controls has now been factored into their 2026 forecasts. And the bull argument here is actually pretty powerful. Even with their single biggest market getting cut in half, they still managed to raise their full-year guidance to that massive 36 to 40 billion euro range. They basically absorbed a haymaker to the chin and are still standing and moving forward.
For now. But what happens when the next round of controls hits? This risk hasn't gone away. It's just been repriced for today.
Right, so we've seen the short-term cracks. We've mapped the geopolitical risks. Now we need to zoom out. The market is often incredibly myopic, just obsessing over the next 90 days, the next quarter. We need to focus on the next decade. The real question is, are these actual structural flaws in the business, or are they just cosmetic cracks in the plaster? To answer that, we have to ignore the day-to-day noise and look at the company's own long-term blueprint for the future. This is where you separate the traders from the investors.
And what a blueprint it is. Seriously, forget the noise around Q2 for a second and look at these 2030 targets. They are guiding for annual revenue of somewhere between 44 and 60 billion euros. That's a potential 50% jump from the high end of their already raised 2026 guidance. But the most powerful number on this whole slide is that gross margin target. They expect it to expand to a range of 56 to 60%. Let that sink in. They are telling the market unequivocally that as they get bigger, they're going to get even more profitable. That is the ultimate statement of confidence in their monopoly power.
So how? How can they be so confident? Well, this slide is the answer. This is their technological moat in visual form. This isn't just about the amazing machines they sell today. This is a multi-year, locked-in roadmap of innovation that no competitor on the entire planet can even come close to touching. From the current generation of EUV machines to the next generation high-NA systems that are just now coming online, they are years, if not a full decade ahead of anyone else who might even dream of competing. This product roadmap is exactly why they believe they can command higher prices and expand those margins all the way into 2030. They're not just selling a product, they are selling exclusive access to the future of computing.
So we've built the bull case, a fortress of AI demand with what looks like an unbreachable technological moat.
And we've found the cracks: shaky guidance, real margin pressure, billions in disappearing cash, and a geopolitical earthquake that's still rumbling.
All right, now it is time for the verdict.
So really, it all comes down to this. On one hand, you have the short-term cracks that absolutely justify the market's reaction. You've got real margin pressure, you have that cautious Q2 guidance, you have the very tangible China risk, and of course, that big, ugly 4.5 billion euro question mark hanging over their cash position. These are legitimate, serious risks that you ignore at your own peril. But on the other hand, you have the long-term foundation. The AI supercycle is not a one-year fad. It's a decade-long infrastructure build-out. ASML's technological monopoly is, for all practical purposes, absolute. Their 2030 growth plan shows a clear, credible pathway to significantly higher revenues and profits. And the underlying demand from their core customers is not just strong, the CEO himself calls it insatiable.
So here it is, the iron financial verdict. After stress testing this entire foundation, we believe the market is focusing on the short-term tremors and completely ignoring the tectonic plates of technology that are shifting underneath our feet. The guidance miss and the slight margin dip, it's noise. The cash burn needs to be watched very closely, but it's likely the cost of investing heavily to build out the capacity they'll need for that future insatiable demand. In our view, these are just cracks in the plaster, not a fundamental flaw in the core foundation. The long-term structural drivers, the AI revolution, and their unassailable technological moat are simply too powerful to be derailed by one quarter's cautious guidance. We see this pullback not as a value trap, but as a structural opportunity. So the final question isn't really about ASML. It's a question for you. Do you have the fortitude to build a position based on the long-term blueprint while everyone else is running from the short-term cracks? Or do you wait until the coast is clear, knowing full well that the price of entry will be much, much higher?
Quick disclaimer, everything I share is for entertainment and informational purposes only. I'm not a financial advisor, so please do your own research or talk to a professional before making any moves with your money.